What is up, everybody? Happy Monday morning to you. Happy Martin Luther King Day as we celebrate that. I am Sean Grapevine, co-branch manager of the Atlanta, Georgia branch, one of the many Atlanta, Georgia branches, and I am joined today, as with every Monday, by the man whose New Year's resolution was to have a record lock day in the first 2 weeks of January, and you gave it to him. He likes his Philly with extra cheddar. He does best efforts with no efforts. His GPA at the University of Texas was higher than today's 10-year T-note. That gets more and more correct, closer to being correct every day. He's the Titan of the 10-year. He's the Baron of Bips. He's the Lord of the Locks. It's Austin Koenig.
Hey, thank you, Sean. And yeah, you're correct. I become more of a normal student like I actually was as we kind of get into a tenure that gets lower. When
Yeah, it
we're
was
talking about the 4.1, that was just a
it was
false
tough to say
statement
that with a
on
straight
multiple
face.
levels. Yeah,
Yeah. Sorry, everybody. We lied. Okay. I
we
mean, he's
we
smart,
lied.
but he's not that
I'm
smart.
I'm smart, but I wasn't a Rhodes Scholar, so by all means, don't
Hey, at
don't
least you
put too much
graduated.
stock into that.
I dropped out. I dropped out of 3 colleges. So drop it in the chat if you can beat that, suckers. Well, welcome, Austin. Should be a pretty quiet day today, but it was not quiet last week. Although the 10-year, as it opens or closed on Friday, is pretty much net neutral on the week. But we had some pretty big news last week. What was it?
Well, you're right, Sean. So we had the inflation numbers come out, which is probably the big banner, release of the week, right? So inflation was kind of for the first time in a long time that I can remember was right on the dot of like what the expectations were. And the expectations were for the headline inflation to actually show like a decrease. We haven't seen that in a while, obviously, because what the headline number is for CPI. Remember, we kind of talk about headline and we talk about core. Those are the two different ones, right? So core was actually still had a growth of 0.3%, but that was expected because we all know rent is sticky. It doesn't go down in price as quickly as something like oil does. And oil and energy sort of consumption, that's something that is very reflecting in price real time. It doesn't take long for that to show up in the data, and that's kind of what we saw, as a contributing factor. But generally, we're down to 6.5% headline and the mid fives in the core inflation. So obviously, we're seeing inflation numbers going down, and that'll kind of quickly continue to go down that path if we continue to see months like we just saw here in December. So what's going to happen next? I think obviously we have another 25.
5.9. 5.9 in February. You heard it here first. Another 0.6.
I like it, and I think whether we get that or not, I think one thing that we keep a close eye on is the jobs market too. Initial jobless claims. There's another release later this week. But we actually have a Fed meeting before the next job numbers in early February.
For the next job numbers or for the next inflation numbers?
Well, before both, I guess. So we have a Fed meeting in early February. So like I think it's February 1 or February 2nd, instead midweek. We're not going to see anything, from the next job numbers or next CPI print that will help guide the Fed in that stance. But I think a lot of the market is thinking we only have, 2 more hikes max, and I think everyone can kind of understand one more hike of 25 bips just to how far we go from there. And I think generally we have a lot of interesting things that'll happen throughout this next quarter and this quarter we're looking at right now in terms of just how the market dynamics are. I think things are going to, kind of set themselves up for the rest of the year. What we look at, I've even seen some articles thinking that our average mortgage rate is going to be 5.7 for this year, and that's quite a bit down from where it is currently. Maybe 40, 50 bips from where we are right now. So definitely encouraging signs there, but it just all depends on what the market decides to do. And there's a lot more than just the Fed out there.
Yeah, for sure. So we've got job numbers. Do you see any if inflation continues to deflate, but job numbers stay strong? So that is the theoretical soft landing. I mean, is the Fed eventually going to blink and say, "Hey, looks like we were wrong. We could conquer inflation without hurting the job market too much," or are they like going to try to drive up unemployment as some sort of like morbid victory?
I tend to side on the front that they would love to achieve a soft landing if they can. I think a lot of even the Fed thinks it's kind of hard to do, but in theory, if they could achieve that, by all means, it would be great, right? Um, if job numbers stay strong, I think, and inflation gets to a point where they're fine with that, I think they'll keep rates higher for longer. I don't think they're going to just say, you know what, we hit the 3% or 2% number that we wanted to hit, and guess what? Unemployment's still in a pretty good spot. We're just going to cut, the Fed funds rate to 3%. That's not going to happen.
Sure,
They don't act like that, and what they'll do is they'll keep, a very close eye in terms of the growth parts of economic data, because what they'll want to achieve is something where we have controlled growth, controlled price growth, as well as keeping a sustainable employment picture. And I think at the end of the day, if we can achieve a soft landing, that's great. There's some banks that have come out and said that the soft landing is more likely. Some are still not very, you know, hopeful
sure,
on that front. So I
sure.
think
I
just
saw
don't
a
invest.
I saw a news article that was like 60. It was like it was meant to be like alarming, but it was like 61% of economists think there will be a recession this year, and I was like, that's probably the amount of economists that think there's going to be a recession every year. I was like, that doesn't seem particularly like it's probably the numbers usually around like 50. 50% of people are even in a good market are usually like going to be like, oh well, the good times are done, whatever. So I was like, 61%, that's not too bad. That means 39% are out there saying we're not going to have a recession, which like is a surprisingly high number. So I'm hopeful as well. I'm just always an optimist. And even if rates do stay high, even if things do get a little rough out there, it's like at least we're in a position at UMortgage that like we're going to benefit no matter what. What like we're going to be the last people to feel the effect because we have the lowest rates, right? People are actually going to be, as we saw last year, driven to us, both from like a clients rate shopping and even recruiting point of view. Like people were driven to us because of like where we are in the rate stack and our ability to continue to offer people uh, great, you know, deals and opportunities. Let me ask you this: something we haven't talked about, and so maybe it's becoming less of an issue. How are the securitizations of non QM uh, deals looking like? Is that happening? Is the credit market in non QM starting to thaw? Obviously non QM is super popular, so it's still being originated, and the rates are reasonable. So there's obviously like some thought that like it's a you know pro- profitable business channel.
Yeah, so I think this market is it's they're starting to kind of wake up again. I would say it's by no means recovered, but if you look at and I've talked to some of my colleagues that are still in this space of credit and trading on either for Wall Street firms or even like on the buy side where they're like representing funds that invest in long-term securities. Credit is something that has gotten a little bit more attractive. It's not by any means uh, where it was in 2021 by any means. So don't even think it's back to normal.
Sure.
But kind of the thaw or the ice age of non-QM securitization is maybe turning a corner soon. I think generally it's still a tricky market out there, and what we need is demand, and we need demand from the buyers of these securitizations, right? And that's how this economic world works. What's also kind of a tricky situation is just what's already out there. Do they want, like, for example, think things that got originated in 2019 or 2020, 2021, they have such low coupons. The way that people price it, it's just it becomes tricky in terms of how they want to
Sure.
look at investing in those sort of things, or they want to invest in new issue stuff. So I think generally there's a lot of different scenarios people are working through and just trying to get an understanding of where do I want to invest this money right now. This very risk-free instrument gives me this much yield on my money. How much more yield do I need to get to go to the
Right.
riskier stuff? And
Mhm.
that's kind of the battle we'll play. I think what will help is banks entering the mortgage-backed security world that we live in a lot, which is agency, like Fannie and Freddie, and becoming a buyer again, and a lot of that stuff, as well as foreign governments. We'll see if that happens because that's kind of where we see the rates driving down for your typical conventional mortgage. And I think with that maybe going down a little bit too, that helps with the the attractiveness of non-QM,
Mhm.
kind of the general profile of some of these bonds, and kind of helping some of those other ones pay a little bit faster and kind of behave a little bit more normally compared to where they're originally priced. So it's I
Wow.
think it's
That
I think
about 100 things to consider, huh?
yeah.
It's at least it's at least a little bit more healthy now, and like we're not like you think we have there's a little bit less risk of like your average non QM lender just shutting the doors tomorrow, like there was like a slew of them in the middle of 2022.
I think there's a better story for them right now. I would say the picture of optimism is starting to become a little bit clearer for them. I think in the near term, whereas when we're seeing Sprout, FGMC shut down, there was nothing but like pessimism. And
Mhm.
really, for all of them, it was a matter of how can we keep the lights on this year uh, and see if we can make it to next year. I think there's going to be generally a little bit more of an appetite around this stuff, you know, starting this upcoming year, and we'll see how that kind of matures and it materializes. But it's just a matter of one of those things that it takes time, and it takes basically almost sometimes a flip of the calendar year, a flip of how the Fed is, attacking things, and kind of just a better, clearer, more economic, a better, clearer economic picture that
Sure.
people can use to actually invest in this stuff.
Well, guys, you heard it here first. Inflation, it's over. Non QM, it's back. And it's just good vibes only for this Monday market update for this year. Last year it was dire, it was dour, it was scary. This year it's just all spin, baby. Inflation's over, non QM's back. Let's go. So anyway, well, thanks for joining us, Austin. What are the biggest pieces of news this week? Payroll at the end of on Fridays, right? I've learned that by now. Some sort of payroll.
Well, so yeah, we have the jobless claims, information that's going to come out. We have a PCE data that comes out the week after, so like the last week of January. Obviously, we kind of talk about CPI a little bit. I guess that's the last inflation number that the Fed will be able to see. But yeah, we just have like a couple different like retail sales, which will be good about checking the temperature of consumer health, which comes out on Wednesday. Really for today and tomorrow, nothing really of major importance. I mean, obviously today the market's closed, so nothing crazy there. But yeah, like continued jobless claims on Thursday, and we have some housing starts data that comes out on Thursday as well, just to kind of see where any sort of development in the housing market's going. So I think that's really the main things to pay attention to. And we'll go from there, and probably a bigger week next week with kind of a full market week. No, market holiday smacked right in Monday.
Sure. All right. Well, we'll loop back around next week, and appreciate you being here. Appreciate everybody who watched. Let us know if you have any questions. Either drop them in the comments or just drop them in the comments. We'll answer there so everybody can see them. Thanks, Austin.
Of course. Thank you, Sean. Have a great week, everyone.